Hello, everyone. Knox Ridley here, portfolio manager with the IO Fund, and this is our weekly broad market update. And just kind of playing off of the themes from last week, we continue to see this theme of divergence within the markets, which is suggesting that this October 13th low was a pretty meaningful low, and we still stand by that. So this price action off that low, I want to give you some scenarios that I see potentially playing out as we go into the CPI print tomorrow. The first is this blue count, and that is that we hold today's low, which is around the 3750 on the S&P 500, gap up, take out 3912, which would certainly trigger some FOMO in the markets as we push into the 4100 region by late November, mid-December. The other scenario that we see playing out would be, say, the CPI print comes in hotter tomorrow and we gap down below 3950. We still think that the October 13th low will hold, and we'll get into why that is in a minute. But I see us potentially finding a low around the 3640, 3580 region, and then turning back up, taking out 3912, and ending up back up in the 4100 range around the same time frame going into year end. Now, the two key areas that matter for the S&P 500 is going to be 3580. If we break below 3580, the market's telling you it's pricing something in that we may not be seeing, and we could be looking at a lower low in the broad market. However, if we can instead take out 3912, that's a really significant level. And the reason why that is that was the recent Fed high. Going into the Fed meeting, the intraday high in the Fed meeting was around 3912. And every single Fed meeting in since January of 2022, the Fed meeting has marked a swing high in the markets that has not been reclaimed. So if the market does reclaim that high, it's telling you that inflation, rate hikes, they're being priced in. And that's something to pay attention to. That's not a market that you would want to be shorting once we take that level out. And so why did I believe that would happen as opposed to 3580 getting taken out first? Is one that, just going back on the last few weeks' webinars, we're seeing divergences everywhere. You look at stocks like JP Morgan, Caterpillar, the financial sector, the industrial sector, the transportation sector. They're all showing relative strength compared to the broad market. And a lot of them are suggesting that really meaningful lows have been put in and that a new uptrend has been started. And then we can look at global markets. We'll get into an update there as well. They also seem to be breaking out of their bear market trend and suggesting that a higher high is potentially on the horizon. And so in order to see those protracted, deep trends like we saw in October and September, typically all markets are moving together in the same direction, and we're just not seeing that right now. So going into a little bit of this, some new evidence is the Dow Jones, the boring Dow Jones Value Index. It has currently given us 5 waves off of its high, which is a very bullish signal. And it's also about 13% away from making new highs and also 13% away from making new lows. And it's reclaimed as 200-day moving average, using that right now as support. And so you see this pattern off the low, you see how far away it is off the low, and you compare that to the NASDAQ 100, which is about 2% away from its lows. You can easily see a scenario where various tech stocks, the NASDAQ 100 makes a new low and the Dow makes a higher low. Once again, that kind of divergence is pretty strong, and it's setting up for a bigger rally within the broad market, including tech. And so if we move a little further on, I think it's important to point out rates and the US dollar, two supporting markets that have really been at the forefront of this bear market. The Fed meeting pushed, this is TLT, this is the iShares long dated bonds, treasuries. And long dated bonds are more controlled by growth and inflation expectations than Fed policy. And so if the bond market thinks growth and inflation or inflation's going up they're going to be selling bonds, right? And so if you think about what the Fed basically said, it said that inflation is still a big problem. We think that it's important to say that we're not done raising rates, and how long we need to keep rates at elevated levels needs to go up as well. The bond market's reaction was to sell off, but it failed to make a new low, which is really important to pay attention to. If the CPI print comes out hot tomorrow and still this ETF, long dated bonds or rates, for example, fails to make a new high, or bonds fail to make a new low, the bond market is telling you that they're pricing in the inflation and the rate hikes. And they're probably going to be more concerned with the growth slowdown than inflation increase. And as bonds get bought, rates go down. That's going to be good for equities, specifically with tech. Now, also the US dollar, I track the dollar index, DXY. Some people may disagree, but there's just a lot of price action to analyze, which I like. This was the Fed meeting right here. Failed to make a new high. In fact, it made its third lower high. And now we're currently testing this downtrend line. If we break that, that's a big signal, but we need to break below 107.5. If we do that in DXY, then a long-term top, I believe, has been put in with the dollar, and that's going to, over the intermediate time frame, be really bullish for equities. And so we're seeing these supporting markets not really reacting to Fed hawkishness like we have in 2022, which I think is an important market to pay attention to as well. And then going with our global markets, once again, whenever you see, when all markets are moving in the same direction, big trends happen. But whenever bottoms or tops are being put in, usually divergences start happening, which is why I've been so keen on this over the last month or so. The Canadian TSX, which tends to lead the S&P 500, broke out of its bear market trend line. Looks like it put in a fourth wave and wants to make a final fifth wave higher. And it's looking to be quite comfortable above that bear market trend line. Then we look at the Australian market. Same situation, breaking out of its bear market trend line, comfortably above it right now, and looks like it wants to make one more high. And then we even look at the German DAX, and you think the US has problems. Europe has a lot of problems, especially Germany, and it just broke out of its bear market trend line and getting quite comfortable above it. With how overbought we are, I expect a retest of this trend line, but if we can hold that and break out to a new high right above right here, then German DAX is telling you that at minimum is putting in, a large bear market rally on the horizon. And so all these markets, all these even US markets and stocks seem to be suggesting they want to go higher, as tech seems like it wants to make one more low potentially. So we do think that the risk is to the upside. And if you just keep in mind the S&P 500 levels that we pointed out, that's probably the best barometer right now. We use an automated hedge signal to help manage risk in our portfolio. It uses a combination of factors, including dark pool, volume, price action, just a variety of factors to help us do risk on and risk off. And it did go to risk off on that Fed meeting. So we remain hedged right now, but we're looking to probably take some of that off for a nice gain if the CPI print does come in hot and we do make a move down into this 3640, 3580 level and start showing some signs of bottoming going on. So anyway, we hope that was helpful. I have a YouTube channel, which you can sign up below. We do these weekly, and we also have a site where we sell institutional research at the iofund.com. We focus in tech as well as in crypto and do this kind of broad market as well as stock and crypto focused analysis, both technical and fundamental. And if that interests you, please sign up there. We have a free newsletter as well. Thank you very much.